Good afternoon, everyone, and welcome to IAB Europe's Economic Trends Forum. My name is Helen Mussard, and I'm joined today by our Chief Economist, Dr. Daniel Knapp. So just for some people that haven't attended one of these before, the Economic Trends Forum we host every 6 weeks, and normally Daniel will do a deep dive overview on a particular industry topic. Given the situation with COVID-19, Daniel has been looking at the impact on our industry and in particular on investment levels. So he last gave a presentation about 4 weeks ago. So today's session will be an update on that. So I'm going to pass over to Daniel very shortly, but just to let everyone know, we do have a Q&A box that you'll see in the middle of the interface. So please do put your questions in there. The presentation, Daniel says, will last about 20 minutes. So I always factor in an additional 10 minutes for him. So let's say 30 minutes, and then we will use the remaining time for a Q&A. So yes, I'll pass it over to Daniel.
Thank you very much, Helen, and welcome everyone. It's a sunny day in London, 27 degrees, and I can promise you that the presentation is going to be, according to the weather, slightly less gloomy than the previous one I did on the 21st of April. So I'm sharing my screen with you right now. What I'm going to do today is provide you an update on the economic impact of COVID-19 on the advertising market in Europe, with a particular emphasis on digital. There's some things I will talk about and others I won't talk about. I will talk about quantifying the impact, talk about numbers and ad spend. I will exclude things like structural changes and how specific advertisers respond to the crisis. That is something that we learn varies not only by sector, but by advertiser. And it is what we can see some trends too early to really fully quantify that in terms of what it means for the market. Some of you will have joined my previous session. For those who haven't, I'll provide a quick recap on what the basic approach is, what we can learn from the previous recession, and how this one is fundamentally different. What I'll do is I'll put in context the April findings and then say what has changed in May. So this is a monthly series, and this is the first update from the initial baseline forecast. Next month, we'll have a new forecast, and we'll continue to do this until we can see that the impact of COVID-19 on the market is easing, and we're all very confident to where the market is going. I always say we're in a highly volatile environment with many, many different factors: economic, political, medical, etc. So previous recessions are not the best template to forecast this one. So everything I say, we have to take with a grain of salt, and I'm heavily caveating everything because my views on this will change based on the data, and they will change continuously throughout the year. But we can now luckily see some fixtures and understand that some things which were just becoming to get clear in April actually have turned out to be true. A quick recap on what we can do. What's our toolbox like? How can we understand what's going on in the market? There are broadly 4 different ways we could do about quantifying the impact. The first is macroeconomic modeling, which is we look at how the economy is doing, GDP, household consumption, industrial production, and so forth, and use those things to quantify what the impact on the ad market is. Good news is this is a tried and tested approach and has fared very well in times good and bad over the last 100 years. Con, things aren't the same as in previous recessions, as I mentioned earlier. So there is some kind of volatility and inaccuracy. And in particular, the government lockdown responses will not immediately be reflected in GDP. And also the economic indicators are fairly slow. We could, and that's what the preferred model of equity analysts at banks is, do a sectoral impact model, which is instead of looking at the ad market as such, we look at what does healthcare do? What does travel do? What does automotive do? And then calculate the relative exposure that each company that they are tracking a Facebook, a Google, an RTL, and so forth, has to these sectors and then calculate what the ad spend impact would be. That works well to evaluate company performance, but industry-wide data on different categories, on different verticals, is hard to get. It's non-standardized across Europe, and we also see in this recession that sectoral dynamics aren't the same. For instance, a P&G and a Unilever were upping spend in this recession, whereas other FMCG companies were actually lowering spend. So we can't treat one sector as one thing. There are huge differences. There are industry surveys and expert interviews. I've conducted many of those, around 40 interviews since the last time we spoke, and also surveys. What will become apparent in a second is that there is some kind of inaccuracy and high subjectivity in all those statements. The last thing is the financial statements, the filings. We didn't have those last time around because the Q1 reports that companies released were just taking place end of April up to around 16th of May. So we now have that signal, which is a huge difference. But as I will show you in a second, there's a tale of two truths going on here. And what the industry surveys tell us is not necessarily that which we see in the company reports. And that makes forecasting this whole market extremely challenging. So this time around, we're going to pick a combination of macro modeling, industry surveys, and financial filings. Quick recap for everyone who hasn't been here. Ad spend is correlated to economic growth. When the economy is up, ad spend is up. When the economy is down, ad spend is down. GDP, household consumption, and industrial production are the main drivers behind this. It's clear household consumption is goods that need to be consumed, and industrial production is a measure of course, the supply, goods that need to be produced. We can also see that ad spend is amplified by economic trends, in particular in areas of downturn, which we could see in recent history. This is the US. If you look at the time before 1990, you could see that even when the economy was up, ad spend was up even more. But when it was down even more. Fast forward to recent history, and we didn't really see these high peaks of ad spend when the economy was doing well. But rather, we see kind of a one-sided correlation, which is when the economy is down, ad spend is down. When the economy is up, ad spend isn't really amplifying that trend anymore. We can also see this in the 2009 recessions if we look across markets. So in Europe, we always saw this amplification effect. So when GDP was down, ad spend was down even more. And the baseline for my forecasts, for those who haven't been here last time, are the IMF GDP forecasts issued in late April. So we again do see this correlation in the markets today. What we've done today is we're going to refine our modeling approach. So here's a quick timeline divided into the key COVID events and what I call signal events, so where we can find some interesting data that helps us understand the impact on the market. And then also 2 points in time where we did our IAB forecasts. So if we look to the first forecast we did in April, the first blue dot on this line, we had all the stuff that was available on the right. We knew kind of broadly how the pandemic was panning out. We saw government responses. We had first local economic data, and also we had harmonized GDP forecasts across countries from the IMF, the OECD, and so forth. We didn't really have, apart from China, company results. So no clear manifestation of what it really meant for ad spend. We did have industry interviews though, and anecdotal evidence. That was helpful. But overall, we did need to rely predominantly on a macroeconomic modeling approach, relating GDP and ad spend and learning from previous recessions. We are today in a better spot, which means our forecasts can be more accurate, just in particular because what we see here in May. We've seen the company reports. And that is now a key component in influencing my forecasts. But I noticed something strange when I looked at these company reports. And that's something that occurs time and again when you try to combine different methods. And that is, if you look at the industry surveys that we see, some by the IAB US, our own surveys, surveys from local bodies, for instance, I'll quote some from France recently, advertiser surveys, We saw a massive downturn in terms of digital spend. We saw search, the survey respondents said search spend down 30% and so forth. Now, when we looked at the Google results a couple of weeks ago, we didn't see any of that. We saw, yes, a mid-single digit downturn in March, but then a stabilization in April. Similarly, we didn't see anything that indicated a strong decline in social from the Facebook results, but rather we saw a flattish market after strong growth, a flattish market in March globally, and then around 0% growth in April. So that's something much more positive, surprisingly positive, we saw from the company results, even if we split this out on a regional level, much more positive than what the industry surveys tell us. And that's a huge issue, because industry surveys tend to survey national advertisers. They are quite accurate when it comes to forecasting the impact on TV spend, press spend, and so forth. But as we saw last time, in particular in digital, you have a huge body of small and medium-sized businesses, in particular in search, and in particular in social. And the trends you see here, these are millions of businesses, 8 million businesses for Facebook. These businesses work very differently with advertising than the traditional big blue chip advertisers that you typically have access to in surveys. So we see a tale of two truths, and we see how very different types of advertisers respond differently. And that means that our digital forecasts, the ones I'm going to show you, are more optimistic than the ones you would typically find in survey-based approaches in national markets. We had some data come in from national markets. So here on the left, you see a sample of data that I was able to research from different markets in Europe. This comes from company filings, this comes from local bodies and so forth. And we can see in most markets, we saw across all media a strong impact of COVID-19. This is Q1 data. So assuming a strong January and a strong February, a severe downturn occurring in March. You could see that the UK, for instance, which imposed a much later lockdown than other countries, was faring particularly well. Slovakia as well. In CEE in general, we see more disparate trends where some markets were actually relatively immune still to COVID in the first quarter. And you can clearly see why. COVID isn't the only thing that's driving ad markets. In particular, in Slovakia, we had a boost due to local elections. In Romania, we had what's called strong comparatives, which means we had a market where there was taxation on telcos and banks and other businesses in 2019, which curbed ad spend then. But relatively speaking, it was up this year around. So many other things meddling into the equation, which makes extracting the full COVID effect quite challenging. But we can see all markets saw a decline in March. And we see that confirmed by agency reports across the board, from WPP to Publicis to Omnicom, that we saw a strong weakening of the market in March. So the data that we say here, if we triangulate it with different other approaches, it does check out. Let's quantify this March collapse. And the French Advertiser Association, France Pub, showed a fantastic example of just how quick, how rapid, how sudden the decline was. We saw here premier trimestre, that's the first quarter. We see the different media categories, and we saw a decline across the board. But it was really March that drove all of this. And just look at these strong double-digit declines here we saw across all media. That's the first difference we see to previous recessions. The effect was faster and more aggressive and more sudden. So we literally had a market crash. And all media are affected, even digital. In the previous presentation I gave, we were wondering about whether the resilience of digital that we saw in the 2009 recession could be reproduced this time around. But we can see digital was hit nearly as bad or even worse than other media. Now, we have to understand, though, that this highlights both the good and the bad about digital. Digital is highly responsive. There are no advanced commitments in general. So you can switch it off very quickly. The good news is if the market rebounds, you can also switch it on very quickly, something we go to in a second. So digital was feeling the immediate effect of COVID-19 because it is so highly responsive and can so easily be switched off. And as markets didn't know how the situation would pan out, we have much more light on the horizon right now, much more visibility. The response was shut everything down. So it wasn't about more performance from digital, more ROI from digital, search driving ROI like in the last recession, but it was switch off because complete uncertainty. And you see, for instance, when you look at television, which fared better than digital display, for instance, that is because in these media you have advanced commitments. So there's always a time lag, which means these media will feel the full effect of COVID-19 slower than digital, but will also take longer to recover. Something again that we will see during this presentation. So the French example really showcases some of the unique dynamics that we're facing with COVID-19 and its effect on the ad market. Something else that we have, which is new, which I fed into our total media forecast models, is the government responses. The University of Oxford created an index based on a dozen or so different criteria, from lockdowns to business stimuli and so forth, to quantify how stringent the government response to COVID-19 was. And you do see differences across countries. For instance, Belarus, which doesn't have a lockdown, scores very low on this index. Similar thing you see with Sweden, which is the only country in Europe still pursuing the herd immunity strategy. You could see I picked the 1st of April because as a first date, as that was a date when all countries had gotten their heads around what to do. And the 11th of May, because it's the last day we have data for all these countries to do a comparison. Did things get more strict or did they get more lax? We can see, for instance, Sweden, things got a bit stricter, but from a very, very low basis. So if you move to the right side of this chart and look at this stringency change, you see some countries becoming less stringent, opening up. Austria, for instance, one of the first countries with a lockdown. Czech Republic, Italy now going out of the lockdown, easing the access to even foreign travelers from, I believe, the 3rd of June. So these are all factors that now allow us to understand how long the impact of a lockdown, of a freeze of economic activity, would be on the ad market. And I use this information to go back to the IMF GDP forecasts and add some adjustments so that we can incorporate the government response and the severity of the lockdown and see what that does to our ad market forecasts. And indeed, I did revise the forecasts. So here you see our all media ad spend growth forecast for 2020 for all the markets in Europe that we cover. So I did a check with the French data, with the WARC data, with some German data and so forth to double check and triangulate. And also looked at other factors like the stringency index, and also in Germany now, the first country to restart its football league. So the Bundesliga start is going to be a much needed boost to the ad market. But most changes overall to all media are minor. And just to track this, how does this look like? So how did, based on new information, how did our view at IAB Europe change from April to May? You see in the top here, the forecast, our April forecast by country, and then the May forecast. And at the bottom, you can see where revisions were made. So we did revisions not in all markets. We maintained our overall media spend model for most markets, but for some markets, we did revisions. Italy, for instance, on the easing of the lockdown. In Sweden, we saw studies from the Swedish central bank that actually laxer lockdown measures, a laxer response provides a less severe impact for the economy, something that the IMF was doubting before. So we factored this in as well to actually ease our forecasts and make them a bit more favorable. You see the UK and the US feature as well, predominantly due to the strong share of digital and the surprisingly positive results that a Google, that a Facebook, a Trade Desk and others were presenting. So how does this pan out in terms of total market forecast and also on the relationship between digital and traditional? And what I said, we didn't touch most markets' total ad spend. We did revise the ratio between digital and traditional media. How's that possible? Well, our model goes from the top to the bottom. We first look at what's the total amount of advertising to be spent in a market, given macroeconomic, political, and other factors. And only then we allocate these budgets to different media. So by forecasting advertising, we always follow the mindset of the CMO, the mindset of the media buyer, who doesn't think in terms of specific media channels, but who thinks in terms of overall budget and then allocates. Which means modest revisions in overall ad spend have led to stronger revisions about the ratio of digital and traditional. And you can see digital now is maybe 50% better than we assumed it to be in April. What are the key factors behind this revised outlook? There are a few. A few I mentioned already, like the improved, surprisingly good results of the global platforms. We also saw in the results, reading between the lines, a consensus across company reports that there was a steep dip in March, but then a balancing out, a stabilizing in the first 3 weeks of April on the level of late March, and then some green shoots, some improvements at the end of April and the beginning of May. It's always tricky to understand in conference calls, in investor calls, what someone means with improvement. And there have been lots of follow-ups by equity analysts later on to ask, what do you mean with improvement? Do you mean growth? Or do you mean less worse? In all cases, it means less worse. So an improvement does not mean that we're going back to growth in May, but that the pace of decline is decelerating. And you can clearly see that if we split out our model, which is on a monthly basis, for the first 6 months of the year. You can see the strong key on the left side. You can see the strong growth in Jan and Feb, and then really the full effect in April, but the relatively fast rebound in May and June. So the key difference in our model is that we are not assuming anymore that every month in Q2 will be as bad as April, but a gradual improvement throughout May and throughout June. That's the good news. That predominantly applies to search and social and the walled gardens. To a lesser extent, it applies to programmatic and other display media. It doesn't apply at all to classifieds, which, looking at company reports from Schibsted and others, we revised downwards significantly, particularly by calculating the exposure of the classifieds market on jobs. So the job market, and that's a huge issue in all of this, the job market will take a longer time to recover, and classifieds is particularly exposed to that. So we see a huge rebound in terms of overall ad spend, but the job market remains uncertain. So if we dive into the digital formats by quarter, we can also see this. So we can see a less severe impact for social and a return to growth actually for social already in Q3. So in a sense, Q3 is the new Q4. That's a key message of this presentation. Previously, we were looking at Q4 to see whether we're going to return to growth. Q3 will be a decisive factor, in particularly the month of September, when we're coming out of summer, whether it's going to grow or not. We can also see that other media are recovering fairly quickly. Video with a very steep dive due to cuts in brand advertising, coming back quickly, and other media just dragging back progressively. A reminder, the digital formats we saw in 2009 were fairly resilient, and we saw that digital was doing better than analog media. But is that really the case across the board in this recession? And the answer is no. Digital versus traditional is increasingly the wrong divide. And in particular, this was emphasized on the WPP and on the Google conference calls, where The key divide was between media that deliver immediate ROI for increased digital activities, in particular e-commerce, and those who don't. For instance, when we looked at the YouTube results, while YouTube was growing strongly in the first quarter still, we saw huge differences between performance-based spend and brand spend. So brand spend tailing off, but performance spend holding much better. If you look at the left side here, you can see how quickly some media that are easy to switch off and easy to switch on again, that are performance-based, recover. So we can already see a social recovery based on our current model by June, July. Search going to follow, and then we're going to see also how banner and video are going to return to growth. Classifieds and directories and other media are going to trail behind. A key reason for this quick growth is, of course, if you look, for instance, at this recent chart on the right from the Bank of America, that explosive growth of e-commerce in the US. A similar situation happening in Europe, where we moved from a gradual change over the last 10 years to a very sudden and immediate change. And all media or ad activities that can connect to new ways of commerce like this are going to win. What we see, based on this recovery cycle as well, if we look at walk data and other company results, is that this rebound we're seeing is not applying to all digital media owners in the same way. We see platforms, scale businesses to rebound much quicker, whereas we fear that in particular publishers, digital publishing activities, and programmatic will be exposed to the recession much longer. Overall, for performance and response-based media, and that's something we can see from the Q1 results in China, it takes about 3 to 5 months to kind of return to growth from the COVID effect, whereas for other media, it can take 6 months or 9 months or even longer. So in April 2020, to conclude, I presented 4 different scenarios of how the full year and the recovery might pan out. With a baseline scenario of a steep dip in 2020 and then a recovery in 2021, with a new scenario with a longer outbreak in 2020, one with a new outbreak in the next year, and then the double whammy with a combination of those two. Today, it looks like the baseline scenario is the most likely, but we are going to revise it slightly by reducing the impact in 2020 slightly, mainly due to the performance of digital, but assuming a slower recovery in 2021. A key concern for all market participants is the growing discrepancy between Wall Street and Main Street. We've seen the stocks rebound, but we've seen unemployment figures surge. Advertising ultimately is about consumer demand. And if consumer demand remains weak, we're going to have a problem. So far, the lockdown and other issues were mainly a supply crisis where goods couldn't be produced, cars and so forth. There wasn't a need for these goods to be produced. But if we move to a structural demand crisis through unemployment and curbed household expenditure, the sluggish ad growth and the recovery cycle might be much longer than we anticipate. And that is a key factor that we will consider in the next presentations and track very closely to provide you with more color on how this recovery cycle would look like, and if new unemployment figures come in, whether we can establish a correlation with ad recovery. And I'll leave it at that for the time being and pass back to Helen for questions. Thank you.
Thank you so much, Daniel. And nice to see some optimism there. So I'm going to open it up for questions. As Marie-Claire's just put here, please do put your questions into the Q&A box in the middle of the interface. We'll start with the top one. So first of all, they say great presentation. Questions around budgets. Are you seeing advertisers focused on domestic budgets rather than global budgets?
That is a very tricky question, and it hugely depends by advertiser. There isn't a one-size-fits-all question. What we see is for many global advertisers, there is a global strategy on how to respond to the pandemic. As advertising is seen largely as a cost center. These cost centers are ultimately managed globally, and therefore the responses to the recession are global. We see in particular in markets where you have small and medium-sized businesses that are stronger, we see, of course, much more local responses. But ultimately, there isn't a one-size-fits-all. I'd say one issue or one area where we are seeing local responses is in terms of anything that affects movement. It could be automotive, it could be real estate. Can you buy a house again? Can you visit and view a house? And travel. So those three segments are highly local, and increasingly, I would say also finance. But other sectors like FMCG in particular remain driven largely by global considerations and not local ones. That's of course an oversimplification, but I hope that gives a bit of color on what we can expect from advertisers.
Great, thanks so much, Daniel. So this question is focusing on the tagline that you've developed. Q3 is the new Q4, and the person just wanted to know whether and how this will impact seasonal ad spending.
Now, we have seen, of course, there's a strong seasonality in advertising. Typically, Q3 is in Western markets, is the weakest quarter in the year, and Q4 is the strongest quarter by far. So in terms of volume, it's Q4 that will drag the market out of the mud. But Q3 is really the quarter that provides some green shoots. It's not going to be, in terms of kind of balance across the year, Q3 is not that strong this time around due to the postponement of Olympics and other things. But those who have postponed budgets often haven't postponed budgets indefinitely, but are still waiting to spend this year. We have a combination now of cheap inventory and an explosion of media consumption, paired with the need to adjust for new consumption behaviors, which are potentially going to stay after the recession. So this provides a great environment to get bargains in Q3, and also to position yourself as a brand that remains relevant when the economy returns.
Okay, great. Thanks so much, Daniel. So this one actually is to do with our industry. I know you talked about employment figures and predictions there. And just to look and focus on our particular industry, what are your predictions when it comes to employment levels?
Quite frankly, I haven't looked at employment levels in the industry recently. We know there's a lot of furloughing. We see anecdotal evidence that people have lost their jobs. Ultimately, what this will do is drive automation, and many companies will realize that they can do the same with less. So my expectation would be, and there's just an anecdotal evidence, and what we've seen in other sectors is that we will not return to the pre-COVID employment levels in the near term or in 2021.
Great, Daniel. And this is following on in the same realm, looking at investment levels. So will we see a permanent shift away from traditional long-term brand equity investment? You know, you mentioned this earlier, some of the big sporting events. And will this go to short-term performance spends, given the weak economic horizons and survival mode for so many categories and advertisers?
Great question. Again, it really depends on the brand. So we have some brands that, of course, had to change their business model more drastically towards e-commerce, where performance-based media are going to be key. But if you look at FMCG, these are companies that will not sell online. You're not going to buy soap or shower gel over the internet, at least not directly. So there, the local environment and the supermarket remains extremely relevant. So for them, actually, it's a good time to do brand advertising. So there isn't really a clear-cut answer whether it's going to be performance or whether it's going to be brand. But everyone has to evaluate now, what is the right media strategy for me? I would say a majority will double down on performance-based advertising. but there are certainly some brands who see this as a strategic opportunity to double down on branding as well.
Okay, great. Thank you, Daniel. So this one is looking at TV. So would you consider that in markets where TV ads are not bought based on long-term contracts, the pattern of changes could be closer to digital advertising?
They could be, yes. And I mean, the long-term contracts, I mean, we particularly have that in the US with the upfronts. In other markets, it isn't the same. So it could trail closer to digital. And this will in particular favor the CEE markets, where we have a much higher spend, a much higher share of TV advertising than in the Western markets. Because we did not really have, we didn't have a free press during the communist times, so newspaper advertising was much lower proportionately than in Germany or in the UK. And the rapid liberalization of the TV market has led to a situation where you got in Romania and other markets a market share of TV of around 60%. So whereas in the previous recession, we saw Eastern Europe being more severely exposed and seen a longer term decline, the structural environment actually favors them. Rapid digitization right now and a high share of TV and a low share of print.
Okay, thanks. So if you were thrown a B2B lens over the numbers, does the outlook change?
That's an interesting one, B2B. I would say yes, and I would say the B2B environment is probably going to be worse than the B2C environment, in particular as events have been cancelled and other things. So if budgets become available and events and physical contact becomes possible again, there's going to be a stronger shift to double down on these activities at the expense of paid media.
Okay. Which country, so this is actually coming from internally, this is from Charlie Curtis, our membership director. So which country in Europe do you think is worst affected currently, and which do you feel will be harmed most in the long term?
Yeah.
Maybe
worst affected right now, if we look at the macro data, is going to be Ukraine. And that's something we've seen in previous recessions as well. That's a market that that grew extremely strongly in the last couple of years, but it has always been extremely volatile as well. So we saw growth rates of over 50%, but collapses of 30% plus. And we're going to see the same pattern play out right now. Least affected are going to be markets in the Nordics, in Sweden, for instance, and also some of the CEE markets with very early, very stringent lockdown measures, such as Poland, for instance. We see good things as well if we look at the macroeconomic environment in the Czech Republic and in Hungary. And I'm a bit more bullish now on Germany that the Bundesliga is opening. In terms of long-term things, what this will of course do is COVID-19 is accelerate structural changes in the market. So I am fairly bearish about a recovery, a long-term recovery in Italy, just excluding all of the economic factors, but about what happens to that formerly extremely strong TV market if budget now needs to shift to digital and the infrastructure isn't there entirely. So these are a few things to consider. Overall, the impact, as I mentioned in my previous presentation, we're probably going to feel it in the ad market as a whole for around 3 to 4 years before we return to pre-crisis levels of investment. But in digital, it will be a year and a half max. And for some media, in particular the walled gardens, the impact will all be gone by 2021.
Great, thanks, Daniel. So this is actually quite a good, I guess, business development question. Do you think there's certain key industries or sectors that should be ramping up advertising spend during these times, perhaps given historical trends, but currently aren't due to the general uncertainty? I'm
always struggling with generalized sector answers because it really depends on the company. I think we're going to see earlier than expected an uptake on travel. in particular for European travelers, not to the extent that we've seen it before, but there will be a bit of a summer rush. Also, I think the FMCG sector is well positioned to advertise right now, like Procter & Gamble and others are already doing, to communicate the value of their goods of everyday use in a time when people spend more time at home.
Okay,
There are
great.
other sectors, of course, e-commerce. Many people call it e-commerce, but it's a varied sector. I mean, delivery services, most definitely. Streaming services, streaming wars will, of course, heat up over this. Need to invest in advertising to drive acquisitions and to reduce churn. But anything that is a discretionary expense that is higher, a new fridge, a new bike, a new car, these are all things that are more expensive that households might not be able to afford anytime soon.
So now we're going to move on to, I guess, the post-cookie era. So with the impending depreciation of cookies and ad IDs, is the current environment a catalyst for change or likely to slow down the necessity changes?
In many ways, this environment is a catalyst for change. Change in the sense of growth for digital. I don't think it will stop or slow down ultimately the phasing out of the third-party cookie, but we're already seeing that some committee meetings, some discussions are being slowed down to give the industry more breathing room. But whether it at all affects the 2-year deadline or by how much, it's too early to say. But I wouldn't say that it gives the industry 6 months or a year of more runway.
Okay, so looking at your forecast, and I know that we're going to be reviewing these every 4 weeks, depending on changes that come into play. So someone here has said, great presentation, logical arguments, but how accurate can your forecast be? What confidence rating are you going to give yourself, Daniel? Given the unknowns for a workable and available vaccine and the potential for a second and even third waves of infection in late 2020 and early 21. So I guess this is kind of looking at the 4 scenarios that you've got up here. But
Exactly.
yeah, how confident are you on these?
So any forecast in this environment is informed guesswork. So there are too many factors that we cannot control. The objective of a forecast is not to accurately predict or describe the future, but to allow us to see the future from the perspective of where we are now, which is limited, which may be wrong, but it gives us signposts. It gives us ideas, it gives us methods to control and to impact what's going to happen. So my forecasts, and I've heavily caveated them, they will change. And I would warn anyone to rely on a forecast and take that as gospel. Everyone's forecast will change. And if you listen to the company investor calls, everyone is extremely reluctant to give any kind of forecast at all because the situation might change. That's the only thing that we can do, is be extremely diligent about the methods we choose on how we forecast, constantly revise the forecast, keep an eye on the situation, and not be afraid to admit that we have been wrong. And I mean, that is how these forecasts should be used, not as how the world is going to look like, but how, based on what we know today, the future could look like.
Thanks, Daniel. No, I think you're spot on that. So this is looking at your favourites, breaking down particular sectors. So at the tourism sector, do you think travel advertisers will have to focus more on branding in order to instill trust again, or will the heavy performance focus remain?
I think it highly depends on the travel segment. If it's about package holidays, I think it's mainly about performance. If it's in other parts of the segment, in other parts of the sector, it's going to be more about brand. Consumers will be extremely cost conscious right now, and the ability to go on a holiday at all, I think, will reign supreme for most. Plus, you've seen, just to add, you've seen some smart travel companies actually, while they're stopped paid media. They did invest massively in owned media during the last couple of months to remind customers of their presence, to provide recommendations for travel destinations once the lockdown is over and so forth. So although we don't see it on a publisher's balance sheet, although we don't see it in the pockets of an agency, though I don't see it in my forecasts, marketing communications for travel has never stopped. It has just moved into other channels, in particular as headcount was available to do that, and the cost was marginal.
Great, thank you so much, Daniel. I think we are out of questions there. We're given another minute just to see if there's any more that came in, but I think we've covered quite a few. Just whilst we're waiting for those, a reminder that we will be emailing this presentation to everyone afterwards, and it will be uploaded onto our website in the Knowledge Hub. Daniel, I don't know if you have any final words. Thanks again for a brilliant presentation and insights.
Well, thanks all for dialing in. If you have any questions on market-specific information, please do let me know. Behind this is a model that is done by market. So if you need specifics on your market, let me know. Also, if you have questions on the specific formats, let me know. I will share in about 2 weeks' time at our Interact conference on the 3rd of June. Another update where we will combine this data with actual 2019 data that we received from the national IABs, which will give kind of more robust historicals and also kind of smoothen the outlook a little bit, because we will get some qualitative indicators from the IABs as well, what they're seeing in their markets, clean that up, and then have a fresh view, like a version 2.5 for you in about 2 weeks' time. So do tune in if you can.
Brilliant, thanks, Daniel. And just for everyone on the line, I've just put a link in there in the chat box to our annual event, which we are doing virtually this year, Interact. And as Daniel said, it's a packed agenda. We've got brands, Coca-Cola, Zalando, we have some members, publishers that will all be taking part in a 2.5-hour live event with Q&A opportunity and lots of audience interaction. So please do register for that. But thanks so much for everyone that attended. Keep safe and keep cool in this heat wave that we are having at the moment. And yeah, Daniel, thanks again.
Thank you. Bye.